The recent peril of Carillion is a timely reminder of the importance of keeping a keen eye out for warning signs when investing in shares. The construction firm plunged into compulsory liquidation earlier this month, after racking up over £900 million in debts and a reported pension deficit of £600 million. Its assets will now be sold off and distributed to its creditors.Ordinary investors, were some of the biggest shareholders in the failed company. They held 16% of shares through the investment platform Hargreaves Lansdown, around 7% via the Barclays Smart Investor, and the same again through Halifax Share Dealing. But they weren't the only ones to get caught out. Some fund managers and institutional investors also had their fingers burnt. And there is no silver lining for these investors, as the sale of Carillion's assets is unlikely to cover outstanding debt, let alone offer shareholders any reimbursement. The sad reality is shareholders are facing a 100% loss.It is impossible to predict the fate of an investment. However, while there is no one measure that definitively flags a company in trouble, there are a number of indicators that should prompt you to tread carefully. The truth is, things don't usually turn out as bad as they did for Carillion, but a big share price slump, or a slow grind down, can still be painful for investors, even if the firm lives to fight another day. Here, we outline 5 key indicators to spot an investment in trouble.A. Their profit margin acts as a buffer against damaging events that can happen to even the best of companies, according to Laith Khalaf, a senior analyst at Hargreaves Lansdown. Profit margin is calculated by dividing gross profit by revenue.A. Low margin means profit can be wiped out at the slightest dip in revenue, or a modest hike in costs, he says. This came home to roost for Carillion.The company posted revenues of £5.2 billion in its last full financial year, but underlying profits of just £178 million, before tax, left a margin of just 3.4%. So if revenue fell by just 4%, the profits would be wiped out entirely.Khalaf said. It's fair to point out that this particular mechanism swings both ways, and a small tick upwards in revenue can lead to a big jump in profit. Companies with very thin profit margins are nonetheless a higher risk proposition for investors, particularly when combined with revenue forecasts that are prone to error, as in the case of Carillion. He adds that the direction of movement in profit margins can also be a warning sign. If margins are moving downwards, that usually means pricing is getting more competitive, or costs are rising, or both. A recent example of a fading profit margin is Debenhams, which had to cut prices to tempt investors into stores, and as a result saw margins fall by 1.5 percentage points, prompting a profit warning. A company with debt on its balance books is not necessarily doomed to failure. In fact, many companies have taken on more debt, also known as gearing, amid the persistence of low interest rates post-financial crisis to fund business expansion. However, a company's business model must be suitable, meaning demand for its goods services must be fairly predictable and margins consistent, so that the interest can be paid without difficulty and interest cover is good, according to Russ Moog, investment director at H.A. Bell. Interest coverage ratio is a good metric to use to calculate how easily a company can pay its interest expenses on outstanding debt. So a company that earns £500,000 during a given quarter and has a debt liability of £75,000 over the 3-month period has an interest-debt ratio of 667. Anything below 1.5 raises question marks over the firm's ability to meet interest expenses. Lenders are also likely to refuse to do business with the company as it presents a higher risk of default. It is also important to be wary of companies with high dividend yields as it could erode growth potential. Jason Hollins, managing director of financial firm Tilney, says, "If it looks too good to be true, it probably is too good to be true." While companies may from time to time seek to sustain dividend payments during tougher points in the business cycle, as we have seen from energy companies during the low points for oil and gas prices, paying out cash that isn't fundamentally supported by healthy cash flows and profits is unsustainable. Dividend cover is a good metric to measure whether a company can pay what it has promised and grow dividend payments in the future. It is the ratio of a company's net income over dividends paid to shareholders.A comfortably above 1, suggests dividends are sustainable, but Collins says the ideal cover is about 1.5 times earnings. He added, "The very best long-term investments develop a competitive edge via a technological lead, a brand or market share, for example, and then deepen your core competence." Carillion was juggling complex, long-term contracts across a range of disciplines and geographies, a feat which ultimately proved beyond it, especially once a small number of big projects went wrong. Mergers and acquisitions can add a degree of complexity also. Carillion acquired construction firms Mallam and Alfred McAlpine in 2006 and 2008 respectively, as well as EGA in 2011 and John Lynn's facilities management business in 2014. Laith said, these deals expanded the company's range of services and geographical reach to bring complexity into the company and take some cash out of it. M&A tends to work best when small, bolt-on deals are used to supplement existing momentum, not create it. Hedge funds are predicted to have made £200 million betting on the falling Carillion's share price. However, sometimes there is smoke without fire, Khalaf said. For instance, Avocado has had a large amount of short interest for some time, but it's defied its critics by finding buyers for its technology, pushing the share price up and inflicting serious pain on those betting against the stock. It is also worth highlighting that only a select few investors have the luxury of shorting, typically high net worth and professional investors, and the view of the minority is not necessarily representative of the view shared by investors in the wider market. Therefore, an influx of short bets should be taken with a pinch of salt, because those who do so may have a high tolerance for risk, or have their short bets are partially covered by the rest of their portfolio, Khalaf says. Investors should therefore only select companies where they have a strong view that things will get better, and should make sure their portfolio is well diversified so they don't lose too much if things don't go to plan. A common practice among fund managers is to scrutinize the heads of a company before investing in it. Howson received a £245,000 bonus and £346,000 in long-term performance incentives that took his total package to £1.5 million. Laith says, in principle, the structure of the bonus mechanism seems sensible enough, as it was 30% based on earnings per share, 20% on cash conversion, 25% on operational performance indicators and 25% on internal leadership and staff engagement ratings. Yet the 2016 bonus contained telling clues for investors, with 0 score for earnings per share, cash, and ratings from customers, while the use of a specific earnings per share figure, 36.1p, was simply wrong, as this can lead to temptation and corner cutting. Even in this case, the threshold was not reached.